Difference should go to discount on bond payable account, which is discount on bond payable, which 7,000.
360.
So debit and credit balance now. Now the question is, this is the first entry when you issue the bond and when you get the cash. But you have to make interest payment journal entries every 6 months to amortize the discount and also to recognize the expense related with the bond issuance. So this entry will show you, see here, this entry showing you bond interest expense should be debited for how much?
5,000
plus
the 736.
Exactly. Yeah. 5,000 plus the discounted amount. And the cash should be credited for 5,000 instead. So expense will be a little higher. If the bond was issued at par, your expense will be the same as the cash payment. 5,000, 5,000. Okay? Now, the next step would be to show the amortization table. This is how the amortization table looks like. Amortization table always shows you the periodic interest payment and the carrying value for each year. So this amortization table is actually calculated using the interest method of amortization. We have two types of amortization table for bond, right? Straight line amortization method and interest, effective interest method. If we are using straight line amortization method, all the interest expenses amortization will be the same. In this case, it will be 736, 736, 736. But this was calculated using effective interest method, then you will have different amortization amounts. Am I clear? So still, starting from 92,000, which is the bond price, the amount is going up every 6 months. Then at last, it will be 100,000, and that's the base one. Okay? So this is a discount amortization. Any question?
Can you post this on your website?
Yes, it's already available for you.
Okay.
It's already available for you.
So we can go back and...
Yes, you can go back and practice on this, especially on how to figure out the present value factors using the formula, using how, you need to know how to apply the bond table, the bond, the present value amortization table. Okay? All right, so this is all about bond price calculation. So now, let's move on to today's.
Did you want these back?
If you want to keep, that's fine. You can keep it.
I'll take them. And thank you for going over that. That was a big help.
Okay, no problem.
Huh?
Because, like I said, bond concept of bond in accounting is very famous and popular topic. Because you need to know what the impact on your financial statement by issuing bond. And you need to know what will be your periodic expense by issuing bonds. Sometimes it will be in favor of the investor, sometimes it will be in favor of the borrower. So you need to know and compare the market rate and the coupon rate. That's the key. Now, let's discuss about corporations. So what will be the financial reporting requirements for corporations? So what are corporations, by the way? Yeah? It's like a business entity. Business entity? Yeah. They are legal entities established by laws.
Right.
And they are separated from their owners. So that's why they have separate legal entity characteristics. So corporations are established using laws, and they should have their own charters or bylaws. The bylaws will guide or dictate how corporations operate. So corporations will have separate legal entity. That's one of their advantages. By establishing corporation, you can avoid risks. So they have limited liability of stockholders. What does that mean when you say limited liability stockholders?
If you have liability, you have to have limited access for the you are taking limited risk also.
All right, so why is it different from partnership or sole
Partnership, if you
proprietorship?
are a partnership, you have to have, you can make judgment, you can have a responsibility.
Okay.
As partner, you will have only limited responsibility or limited ability to make a decision as well.
Right. Who else? Who else can help out?
Right, but the stockholders are liable for the company's business.
Okay.
Well,
Right? If you're a limited liability, stockholders are responsible financially and they can lose their personal assets. But if you're a corporation, that's where the protection is for the individual. Because if you're sued, you would only be able to sue
Right.
the company
Right.
and its assets, not the owner, the stockholder. There's a protection.
Right. So in other words, corporations have the same rights and privilege as individuals.
Right.
So that means they can sue or they can be sued. So when we say corporations have limited liability of stockholders, creditors cannot go beyond the initial investment of owners. So let's say, let me just give you some examples. Let's say the corporation has profit of 100,000, right? So if the board of directors approve dividend, and let's say the dividend of that corporation is 60,000, then how much is actually the retained earning or the profit, the net taxable profit?
Out minus.
So 40,000. So the corporation has to, they have 40,000 profit in this case. Let's say they have loss. Let's say, let me make this 120,000. And they have loss of 20,000, right? So let's say the corporation cannot pay that loss, or they have risk of uncertainty in the future. So do you think the creditors go beyond that 20,000 loss
No,
and
right.
claim that loss from owners?
No, they have limited liability, they can make it.
Right, because they have limited liability, corporations have limited liability, that means creditors cannot go to personal
Correct.
assets of those shareholders. That's what it means. So partnership, let's say partnership have loss and that partnership cannot pay any loans or credits balance. So do you think creditors or any other parties go to personal assets of the owner?
No?
In the case of partnership, yes.
Oh, in a partnership, they will.
In the case of
yes.
partnership, yes. If you are sole proprietor, if you die, then the sole proprietor or the company
It
will not
dies with
continue.
you.
It dies with you. So that's why limited liability of stockholders is a really great benefit by establishing corporations. Transferable ownership rights. What does that mean?
it means that if I die, then somebody else can step up. and
Yes.
become-
Somebody else can step, or you can sell your ownership rights somewhere on New York Stock Exchange market, and especially if the corporation is publicly traded corporation, then that means somebody else can buy that share and can be owner of that company. Continuous life, like I said, if the owner dies, then the corporation still
Right.
continue. Lack of mutual agency for stockholders. Stockholders are not actually agents of corporations. Who are agents of corporations? Managers, directors, presidents, or officers. They are agents of the corporation. So when we say, let me go back. Lack of mutual agency of stockholders, that's what it means. Ease of capital accumulation. Why it's easy to raise capital by establishing corporation?
Because you sell.
Sell
stock.
shares, stock.
Yes, you can easily share stocks.
Right, you can sell it to your employees.
Your employees, there's stock incentives, and you can go to stock exchange market and provide you shares so that people can buy. So you will have more owners by just issuing or selling stocks. So you remember from last discussion, we have two types of financing, right? Debt financing and equity financing, right? So in this case, corporations are using the equity financing option to raise their capital by just issuing their stock. So it's very easy to accumulate capital. But we have also disadvantages. Government regulation and corporate taxation. We have high or strict government regulation on corporations because they are high or huge amount of taxpayers. So because of that, government has strict regulations on corporations. And another advantage is double taxation, corporate taxation. So what does that mean when we say double taxation?
You will pay regular taxing, also they will pay for the corporate tax.
Who they?
The corporate.
Corporation will pay tax,
Yeah.
and also who else?
The
employees.
owner.
The
The owner. Shareholders will pay tax. Yes.
Is it true that like if you have like I think it's like Roth IRA or something like a retirement account, you don't pay taxes on like dividends and like capital gains tax?
Yes. Yes. You don't pay. There are some exemptions that amount that you don't pay tax on it, like individual taxation, individual amount or on your income, gross income. There are some limits that you don't pay tax on it, like on IRA, rollovers, stuff like that. So the same taxation concept applies on corporation. So in this case, let me give you how double taxation really affects the profit. Let's say we have a profit of 100,000, right? For a corporation, right? So they have to pay tax on this, right? But before that, they have to distribute dividend. Let's say this is net income, right? So let's say they have to issue dividend of 50,000. This dividend is going where? To the shareholder, right? So they have 50,000 taxable income now. So they have to pay tax, let's say 40% tax rate. They have to pay tax on this 50,000. And also the shareholder, when they get that 50,000, they have to pay tax.
Right, because there's
So in
a
this
special
case-
form you get from the corporation saying, we've paid you this dividend,
Right.
and it's submitted to the IRS.
Right.
And that's how,
Right, because the shareholders, when they file their taxes, when they file their personal income, because of the K1 or other distributable amount, they have to include that amount on their personal income. So they have to pay tax on this. And also the corporation is paying tax on that. That's why when we say double taxation, that's one of the disadvantages of corporation. So let's look at the organizational structure of corporations. Who owns corporation? Who is the owner of the corporation? Stockholders or shareholders. They have ultimate control on the corporation. And stockholders usually meet once a year. Then stockholders can elect board of directors. And board of directors can appoint president. And the president can hire the managers, vice president, officers, or vice president CFOs. So in this case, board of directors will have the responsibility to hire auditors. And they need to make sure they have, or the corporation have strong internal control. That's their major responsibilities. And the president's responsibility will be to develop the vision and the mission of the corporation. And it will control, he will control the overall activities of, day-to-day activities of corporation. And like I said, the board of directors are selected by the vote of stockholders, and also board of directors will have responsibility for managing the company. So we have stock. What does that mean when we say stock, by the way? What does that mean when we say stock?
well, there's,
Can anyone
there's all
anyone tell me
kinds
what
of
stock
stock.
is? Yes, go ahead.
There's different types of stock.
Yeah, we have two types of stock.
So there's common stock,
And
The shares, the corporations and all that stuff.
right? What else?
Market value stuff.
Market value, that one way of calculating the retailer. Can you tell me what stock is back there? Can you tell me what stock is?
Money, buying part of the property from the,
What you turn? Yes.
Like, you want like the definition, like of stock?
Yeah.
Isn't
What
it
does it
like-
mean when we say stock?
Is
What
it
does it
like
mean?
partial ownership of a company?
Right? Okay, that's what I'm looking for. Who else? A stock is a type of security, right? Which represents like we said, ownership of a corporation. Because by just having the stock or share, you become owner of that corporation, right? So a stock is a type of security which represents ownership of a corporation. Or it can represent a legal claim on corporations' assets or profits or earnings. By just having a share or by acquiring a stock, you will have a legal claim over assets and earnings of a corporation. Because you have a stock, you can claim assets. If the corporation liquidates, because you are owner of the corporation, right? You can claim the assets. And also, you can claim the profit. You can share whatever profit the company is making. Okay, so we have, this is stockholders section of the balance sheet. So on stockholders equity section of the balance sheet, you can show par value times number of shares, which will give you the total equity of that corporation. So in this particular example, what is the par? 0.01. You see this 0.01?
so it's
And-
for a penny.
Not only always a penny, par is the amount stated on the stock certificate. That's the price for one stock. So here, if we have 250 million shares and the price for one share is 0.01, then how much is the stock? Just multiply 0.1
Times one.
times 250,000. Let me just simplify these numbers here. Let's say you have 10,000 shares, right? 10,000 shares. And the par value for those shares is, let's say, 10. This stock has 10 par value. So how much is the total stock?
times 10 then.
Times 10, it will be 100,000. So on your balance sheet, equity section of the balance sheet, you will report 100,000 as the value of that share. Okay?
And that's common.
100,000.
That's
Yeah, but-
common
Stock.
stock.
Yeah, common stock. It can be preferred stock, it can be common stock. So we'll see what the difference between preferred stock and common stock later on. So on your balance sheet, you have to show your capital or your total equity as 100,000, which is 10,000 shares issued at par value of 10. Okay? So in this case, 925,000. So what is the difference between authorized capital and issued capital? Sometimes companies set a limit, legal limit, where they can sell their stock because there is a minimum or maximum requirement.